our view is if the dollar continues lower and rates go lower, financial conditions are easing, and that gives a 9-month lead. So it might push it out further than we expect. We don't know yet, but definitely doesn't feel like the end of the cycle is going to be this year by any stretch.
Yeah, every cycle is different but the same, and it just feels like the scar tissue from the last cycle, which we all felt, is manifesting in a lot of the commentary that's coming through at the moment.
Every crypto cycle raises the same question. Is it over? Many investors believe Bitcoin's peak has passed, but data from Real Vision's Raoul and Jamie Coutts tells a different story. After studying market structure, liquidity trends, and on-chain activity, they conclude the bull market isn't done. It's only entering its most profitable phase. This cycle looks different from 2021. The market is shifting from speculation to fundamentals, from hype to real utility. Bitcoin still leads, but high-quality altcoins and revenue-generating projects are now taking the spotlight. Institutional money is flowing in, liquidity is expanding, and investor sentiment is maturing. According to Powell and Coutts, Bitcoin could still reach between $150,000 and $250,000, while altcoins may see explosive growth through 2026. The message is clear. The bull run isn't over, it's evolving. Do you think this is the start of crypto's next big wave? And which altcoin do you believe will outperform in the next phase?
I think just top level, everybody always wants reassurances. Is it over yet? Are we all doomed? What's going to happen? Have I got the wrong tokens? Just there's so much fear in the space, and there's a lot of hand-holding needs to be done. So I guess we start at top level of, where the hell are we?
Yeah, well, I mean, let's talk about market psychology. I think, every cycle is different but the same, and it just feels like the scar tissue from the last cycle, which we all felt, is manifesting in a lot of the commentary that's coming through at the moment. Right?
Yeah, agree.
Now, it's a 4-year cycle. This is when it has to end. Therefore, it will, last cycle, it was to the moon forever, because no one is keeping an eye on, or no one really, there were people such as yourself who were really getting a good handle on it. And it was really in early.
No, even I failed in the last cycle because I thought there was another leg to go. So
yeah. So then everyone's sort of, I guess, truncated this cycle, and for good reason. It's not without, that there are frameworks out there that are credible.
Still paying taxes on your crypto gains? What if you didn't have to? With ITrust Capital, you can buy and sell crypto inside a tax-advantaged IRA, giving you a smarter way to grow your portfolio without worrying about capital gains tax. That's why they're the #1 crypto IRA platform in America, with billions in tax-advantaged transactions. There are multiple ways to fund your account. You can make a contribution, transfer an existing IRA, or roll over an old 401k or employer plan. You'll get access to a wide range of digital assets, low fees, and 24/7 trading, all backed by secure, one-to-one asset ownership with institutional-grade custody. And if you have questions, ITrust Capital offers 100% US-based customer support with real people ready to help. Click the link, use code DOSE7, and get your $100 funding bonus today. Start building your crypto wealth, tax-advantaged, with ITrust Capital.
That should say that, this is, a time when things start to get, peakish. But we haven't had the typical business cycle, and not many people do that business cycle analysis that you and Julian do. So that framework that underpins everything at Real Vision and GMI is sorely missed elsewhere. But it just feels that, it's a mechanical response to the market, that this is now when we should be peaking. And it's been interesting to see the commentary flying on Twitter and everyone else, and even within our membership here, about is the top in. So I'm always fascinated by market psychology and how it manifests in the market. I also think what's quite interesting is that everyone is very attuned to the liquidity cycle aspect now, and how that is going to change the outcomes in the future, as much as we think that, we've still got more to go. And all those things are they're the unknowns, but the framework that, we have here is very, I think, very clear that we have got more to go. I've got we've talked about my Bitcoin cycle risk framework and the topping indicators that I've been building. I mean, they're not screaming at me euphoria. There is definitely definitely, and I highlighted this in that last report, Raoul, trend exhaustion signals in the Bitcoin chart and fundamental deterioration as well. But I think that's a function more of the transition into higher beta crypto through ETH primarily.
So the falling of Bitcoin dominance, which is typical of this point in the cycle anyway, right?
Yes. Yeah. And that transition really started, second quarter, but it was very clear by sort of July when I was on paternity leave, that transition had occurred because I looked at the on-chain data on Bitcoin, the ETF flows between Bitcoin and Ethereum, and obviously the price action. And it very much lines up with, that transition period in the crypto market from Bitcoin dominance to high quality alts, not a dash for trash sort of market that we saw in 2021 when people were getting stimulus checks, but a high quality alt season run at the moment. So that's kind of where I'm at.
And when we talk about the high quality alt season, I want to see where your head's at. My head's at is quality layer ones, revenue generating projects, and a few big things that capture attention, whatever they may be, that don't come with revenues or anything else, but they capture attention. We're seeing, Hyperliquid's obviously one of them, maybe Athena's another. We're seeing obviously Sui, Solana. How are you thinking this next phase is, and what are the types of tokens that participate?
Yeah, I like the way that you've just distilled that down into a very clear sort of representation of what really matters. Cash flows. Are there protocols that are fundamentally strong, meaning that they have cash flows, they have usage, they deliver utility, and have very strong tokenomics? And there are a handful of those, and they are being rewarded by the market as they should. I've always had this view that as the asset class grows and as the, for lack of a better term, sophistication of the marginal new investor comes in, that they're going to look at fundamentals more and more. It's always been my base case. And I think that's playing out. I mean, you mentioned Hyperliquid generating a huge amount, generating the sort of cash flow or revenues that would make a, NASDAQ 100 company sort of water, like in terms of just the growth. In terms of like the multiples, I know we're not talking like for like, but in the case of Hyperliquid, it's trading on a revenue multiple that would put it, in the median of a tech stock in the S&P. But it is those high quality, tokens, L1s and the DeFi protocols. And yeah, the things that will grab attention because, that is not going away. Memes are definitely not going away. In fact, I'm starting to entertain maybe my first, meme position, which we can talk about later. Because
by the way, the Doge, ETF launches tomorrow. So by the time this is out, it'll have launched, which is interesting.
I was going to put it in my, that was one I was going to put it in my note. So yeah, no, I think it's a much more discerning market, and you're not seeing the broad-based rally. I mean, we're still, I think, early stages of this sort of broadening out or alt season, for lack of a better term. But it is going to be a very discerning type rally until we get to the end, when there will be short-term pumps and small caps, real small caps with, no product market fit that will start running. And that is on my, that's on my checklist for a market peak. And we're not there yet.
Raoul Pal and Jamie Coutts say investor fear is misplaced. This cycle isn't over yet. While Bitcoin shows signs of slowing, on-chain data, ETF inflows, and falling dominance suggest a shift toward strong altcoins, not a peak. Their real vision models still point to major upside ahead. Both highlight global liquidity as the real engine of growth. Since April, liquidity has surged, a signal that often fuels the next big leg in risk asset. As it rises, it first lifts Bitcoin and Ethereum, then flows into quality altcoins. Their message is clear. The bull market still has room to run.
Where is your measures? Because you look at liquidity too, and you've been posting some stuff on X about it. Give us your top down where we are on the liquidity cycle from your perspective.
So I think April for me was the demarcation of an important inflection in liquidity, because I have my own global liquidity index as do you. And they're all sort of like proxies for kind of what we think global liquidity is, and they differ a little bit. But once you regress these things, they have a very strong correlation. And if you do sort of like predictive measures like Granger, causality, and whatever, yes, it does have very significant predictive value. So I do use it a lot, but I also, appreciate that it's not a perfect one-for-one for global liquidity.
No, and people get confused over that. It's a roadmap. It's the contextualization of where we are in the cycle and what to kind of expect, as opposed to, oh, well, it went up today, so in a month's time it'll go up. It's like, it doesn't work that way.
Yeah, exactly. It's going to wiggle. It's going to surprise a little bit. But like from my first principles basis, global liquidity goes up. That increases the marginal demand for risk assets, and the preference for risk asset investors is the assets that give the most protection to monetary debasement, which is why they've got marginal new dollars coming into the financial system to buy assets in the first place. So, but that sort of what I call like a super bullish regime, which is just like using technical analysis on global liquidity, looking at the breakout that happened in April, gives us runway for another, typically though these periods of like the breakouts last for about 2 years based on previous cycles. But this is the ascent of global liquidity this cycle is far more moderate for reasons we can get into. But like, I think that, and also let me just, also add that global liquidity increasing is not, or the absolute level of global liquidity is not the most important metric. It's the rate of change, and risk assets will sniff that slowing down. So I think there's another sort of 6 months left in the cycle. And I know that's pretty much lining up with where you are as well. Maybe it's a little bit more, maybe it's a little bit less.
Well, our view is if the dollar continues lower and rates go lower, financial conditions are easing, and that gives a 9-month lead. So it might push it out further than we expect. We don't know yet, but definitely doesn't feel like the end of the cycle is going to be this year by any stretch.
Well, yeah. And so, that actually, that correlates to what I see on the chart here, because we've just broken above. Like, it's been sort of 5 months where we're in this sort of new regime where global liquidity is higher than where it was at the peak of the last cycle. And that usually, and, I've got another chart here which looks at sort of liquidity versus debt, which I think is the critical metric. And the problem is that debt has been growing at a clip. Like, I think since 2023, when I ran the numbers, US public debt has risen by about 15%. GDP has gone up by 10%. So there's a 5% differential there. That is a problem. The bigger problem is that the liquidity growth is around 3 or 4% since then. So there's almost
I've been trying to think this. I've been trying to think this through, Jamie, from, you and I swapped that chart where you send it over to me and said, what do you think? And I'm like, yeah, okay. And I've been thinking, my fear is we're not measuring part of global liquidity. And that's the duration of issuance, right? The bills, I don't think is getting captured by any of our work. Somebody else on Twitter posted something about it today that they're working on it. And I fear that somehow we're missing yet another liquidity lever that we didn't know was coming, which was like, we're not going to issue at 5 years anymore. We're just going to issue in the first 3 to 6 months. And that's more, and Mike Howe was on the podcast today, and it was like, that seems to be more liquidity that maybe you're not capturing in this.
I would be the first to admit that. In fact, when I put this on Twitter, that's exactly what I said like a week or two ago when I put it up. I said, I'm not capturing this, this new form of liquidity that's coming, directly from the Treasury rather than through the central banks or the monetary based metrics that make up my liquidity measures. So I would definitely agree with that.
Could we measure it as a proxy using the rate of change of money market funds? Something, because these get issued somewhere, right? They either get issued into stable coins or generally issued into the banks or into money market funds or some combination. I wonder if there's an easy proxy, or do you have to go through and clean the data and do all of the laborious work of figuring out exactly what was issued and where in the curve?
I thought about stable coins and using that as trying to blend that in as a way to capture what the Treasury is doing, but I hadn't really thought it through in
No.
a
It's
constructive
just interesting.
manner.
It's been in the back of my mind. Like, we haven't got, it's not complete yet.
Yeah, and it feels like this is the conversation we're having in like mid 2022 when we were like building stuff and we were having these conversations and we kind of came to the same conclusion about like where the bottom was going to form. But I haven't done the work, and I'm sure you guys will, as will I. But I think it's definitely missing because obviously that's since Yellen, that has been the playbook. The quantitative, the balance sheet's been tightening for the last 3 years, but Bitcoin is up, and that's because liquidity is being pumped in through other mechanisms.
And that's why we've been using the total liquidity as opposed to Fed net liquidity, and before that, the balance sheet. Here's another interesting thing that we found in GMI. We're like, why is this business cycle longer? Part of it is like rates haven't come down. Okay, fine. Then we went back and did the foundational work again about debt maturity. And what we found is back in 2021, they lengthened the maturity of the debt because rates were low.
Yeah.
And so now, 4-5 years later, we're having to roll that debt. And it's because it was 5 years and not 4 years after the 2021 cycle. They extended the cycle by a year because they extended duration. Now what they're doing is looks like they're shortening cycle. And so it might bring the cycle back again. Or if they continue to just issue in the short end, maybe we don't get a cycle. I'm not suggesting that's the case, but just intellectually, it's interesting to see, and if they just continue to issue the short end, there is no cycle because it's just endless liquidity.
So I would love to see the work on the composition of debt based on maturity. It's not that there's endless liquidity. It's that the system is way more fragile in that environment, right? Because they have to be, they have to constantly be on the case in managing the financial system and, making sure that volatility in the bond market doesn't start creeping. Because like with the previous regime of more long dated issuance, there was these cycles of like 4 to 5 years and, they became, I think, a lot more sensitized to it and able to get ahead of it. Now they've just basically turned into a short-term, a short-term liquidity engine, which I think causes a whole bunch of other problems.
It's like basically buying a car on a credit card.
Yeah.
As opposed to, a 5-year car loan.
Right. Which could accelerate the exiting of, from US treasuries in one aspect, but maybe stablecoins sort of plug the hole. I don't know. It's incredibly interesting, but obviously there's just more liquidity, more cowbell.
Powell and Coutts believe this crypto cycle is far from over. They argue that global liquidity shifts, debt issuance, and treasury management are extending the bull market, not ending it. Short-term issuance keeps injecting liquidity, supporting risk assets like Bitcoin and Ethereum. Altcoins with real fundamentals, from DeFi protocols to Layer 1 projects, are attracting major capital, and even memecoins are evolving as tools for liquidity and attention. All signs point to a broadening phase, suggesting the market could stay bullish well into 2026. Their Cycle Top Finder indicator supports this view. In past peaks like 2017 and 2021, it spiked dramatically before crashes. Now, while Bitcoin trades high, that mania signal hasn't appeared. Liquidity remains strong, sentiment steady, and the data shows no signs of a top. For Powell and Coutts, this isn't the end, it's expansion. Do you think this bull cycle can really extend into 2026? Which altcoin sector do you see leading the next leg of the market? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.